let's go to lesson number two. Buy more when stocks drop sharply. Here's the quote. I simply take my cues from the magnitude of the market's decline, and the bigger it is, the more enthusiastic I am about buying. That may sound naive, but after decades of investing, buying aggressively during a bear market, coupled with leaning heavily towards stocks and favoring index funds, are the only ways I know to get an edge.
So, Charlie, started writing about finance in the mid 1980s. And at the time, there were always these grumpy, wizened old men warning that the market was overvalued. P/E ratios are too high, price to book value is too high, the end is nigh. Small investors are stupid, they're overenthusiastic, they will pay dearly for buying at these prices. And I heard this chorus again and again over the decades, and anybody who listened to them would have left serious money on the table. What I came to realize is that we really can't forecast the direction of the stock market, certainly in the short term, based on valuations. And these, talking heads, warning of apocalypse, you know, are leading people astray. It sounds so much more sophisticated to be pessimistic rather than optimistic. But the pessimists are the ones sitting on the sidelines while the stock market is going up. So yes, whenever the stock market goes down and the talking heads are extremely pessimistic, my gut reaction is I'm going to buy. It's a knee jerk contrarianism. But one of the things that I've done, and I did this in 2007 to 2009. I did this in 2020. I did this in 2022. Is I take my target allocation to stocks, and then when the market drops 20% plus, I buy even more than my target allocation on the bet that the market is going to eventually rebound. I don't buy aggressively on day one, but I think over rebalancing into stocks during market declines is one of the ways to improve your returns over time. It may not be for everybody. It depends on your risk tolerance and so on. But for me, it has been a very good strategy.